Hello everyone, welcome to Yadnya Investment Academy. In our last video, that is part 2 of gift tax series, we discussed about tax implications of various parties during gifting process and also about income clubbing provisions under gifting. In this part, that is part 3, we will discuss about tips to save tax by gifting. If you haven't seen already, we would request you to see part 1 and part 2 of this series to understand this part better. We know that if we are gifting money to spouse, minor child or daughter-in-law, income clubbing provisions are applied. But we should know clubbing provisions will not be applied when the gifted money is invested in any investment option which are tax exempt by default. For example, rather than a normal FD, if the money is invested in tax saving options where interest is not taxed, that is those which have triple E status such as PPF, ELSS, etc., and redeemed after maturity, then income clubbing provisions won't apply. Similarly, you can invest in stocks of a listed company or equity mutual funds and sell them after 1 year, as they have zero long-term capital gain tax. Then also clubbing provisions would not pose any problems, as by default income earned from these instruments is tax-free. Thus there would be no additional tax liability due to clubbing of income for either giver or receiver, and all the income will go to receiver, that is gift receiver's account. You can save tax by gifting money to your parents or in-laws because clubbing provisions doesn't apply in these cases. Any income generated on the gifts to parents is purely parents' income and will be taxed in their hands only. Let's understand this with an example. Assume that you have rupees 10 lakhs in your hands which you want to invest, and your father and mother both are senior citizens. Now what you can do is gift rupees 5 lakhs to each parent and let it get invested in a bank FD at suppose an interest rate of 10%. Now both of them will get rupees 50,000 as the interest income individually. And if after including this rupees 50,000, their total income in the year is less than the exemption limit, which currently is rupees 3 lakhs, they wouldn't have to pay any tax. This way you have invested rupees 10 lakhs in parents' name with zero income tax on interest income. On the other hand, if this 10 lakhs was invested in FD on your name, and assuming you are into 30% bracket, you would have paid 30% income tax on 1 lakh of interest, which is rupees 30,000. This whole 30,000 is saved when you invested your money in parents' name. Even if your parents are having additional source of income, it's still beneficial to gift the money to them, as it would lower the income tax outgo because of the lower tax slab and applicable exemption limits. So as far as your parent tax slab is lesser than yours, it is a good option to save tax. You can apply the same logic and invest in property in parents' name and let the income come to them and enjoy the tax-free income subject to exemption limits. Like in tip 2, in the same way, even the money gifted to major children will not be clubbed in your hand. So in case you have children who are 18 years or above who are not earning or earning at a lower tax slab than you, then gifting your surplus money and investing in their name will neither attract gift tax nor clubbing of income will apply. This is really a good thing, because if you are going to pay for some upcoming children expense such as education goal or marriage goal, then instead of investing the money in your name and funding the goal later, why not just gift the money to child and invest in their name itself? When the goal arrives, the money can be used, but for years there will be no or lower tax liability, and you will save a good amount of income tax. As you may have seen in last part, due to clubbing provisions, gifting to spouse is not too beneficial. But what if spouse needs money to finance some investments such as home loan EMI or insurance premium? In that case, it is better to provide loan and not gift to the spouse with reasonable rate of interest. Please do remember that taking and giving of loan transaction between the spouse does not attract the clubbing provisions as in section 64 of Income Tax Act. This is all we have on the topic gift tax. You can see all the three parts in the government regulation playlist in our YouTube channel. If you have any questions, please do write in the comment section below. Have a great time ahead.